Hi, everyone, and welcome back to another episode of AI InterConnect, the show where we explore how bold mind and smart technologies are reshaping industries from the inside out. I'm your host, Laurent, and today I'm joined by someone who's been blending strategic finance, real estate, and operational clarity long before it became a trend. Stewart Heath is the CEO of Harvard Grace Capital, an investment firm helping passing investors build wealth through commercial real estate, fractional CFO services, and creative financial strategies. He's also host of the Growth, Grace, and Prosperity podcast. Um, a lot to learn from you. Stewart, it's a real pleasure to have you. Welcome to the show.
Well, thank you for having me. It's quite the honor to be here. So happy to be your guest.
Wonderful. That's going to be a great conversation. We're going to learn a lot. Let's rewind the clock for a minute. Before Harvard Grace Capital, before syndication and tax strategies, what first drew you into the world of finance and real estate?
Well, drew me into the world of finance. My father was a CPA as well. I never really knew what that meant. Um, I did a bookkeeping course once in high school. So, well, that was fun. And then majored in accounting in college and followed that career path. And well, that sounds great, then I got into the working world and I realized I was a lot more entrepreneurial than most people drawn into accounting. It's a great education. Uh, don't don't have any regrets for any of my accounting and tax education and work. And I'm just I just never could shake that entrepreneurial uh, blood in my bones, so which later discovered I was a whole lot more like my mom in that regard than my dad. My dad, CPA, worked for the same company for 38 years, and retired a partner with Ernst and Winnie, and did great. I mean, but it's like, how many people stay with the same company their entire career these days? Hardly any. And um, so, as I was pursuing that, it's somewhat interesting. So I'm coming out of college. Got out of college in 1985. A little bit more than a year later, the Congress passed the 1986 Tax Act, which had a devastating effect on investment real estate with retroactive uh, tax stuff. So, stuff people had already done suddenly had different tax treatment than it did when they got into the deal. It was horrible policy. Anyway, it is what it is, and there for several years, um, it was very difficult to sell a piece of commercial real estate like an apartment building, or to finance it, and banks were running around saying, yeah, we don't lend on real estate anymore. That's just, real estate is passe, it's old, that's the old world, and that's crazy. So and I'm very young in my career, and listening to all this is okay, all right, no real estate, um which is just stupid on its face. I guess the banks then preferred real estate, preferred collateral that had wheels and could go to another state easily. But so after I'd left Price Waterhouse and started my own firm, most of my clients that I was picking up were in some way, shape, or form part of the real estate business. They were contractors or realtors or fixers and flippers and or all of the above. A lot of real estate entrepreneurs wear many hats, and so I've been doing that for about 10 years. And it was sort of late one tax season, and I'm sitting there realizing, okay, real estate's bad, except that all of my clients over here are making all kinds of money and they're not paying any taxes. And I know they're not paying any taxes because I'm doing their tax return. And so it made me, do rethink all of this real estate is bad stuff. And so I just began to dabble in it. One day I bought a duplex. I put down $5,000 and then convinced the seller to take back a mortgage for $50K. And hey, I was in the real estate business and I was kind of hooked. It was, I loved it. I liked interacting with the tenants. I liked the recurring nature of the cash flow. I even enjoyed property maintenance, when it wasn't too onerous. And from there, I just started buying more and more units, primarily residential duplexes and condos and things like that. And that's what got me stuck on real estate, and I'm still doing it. I have converted from residential to commercial, just because I like the more longer term nature of the leases. And I mean, you just make more money. It takes more money to get into commercial, but you can get into real estate investing with almost any amount of money. So
Wonderful. I love that story. That's great. So then pass, and you've built Harvard Grace Capital around a strong mix of services, fractional CFO advisory, capital raising, and real estate syndication. How did you decide on that blend, and what was the strategy behind it?
um, I'm not sure it was a conscious strategy. So Harvard Grace was doing fractional CFO work really before we started doing syndicated real estate. A lot of our clients had interest in real estate, or they were completely in the real estate business. So that was a natural for us, given our other interests in real estate. Some of my clients, even going back to my earliest days as a young CPA, were syndicators, not necessarily of real estate deals. So I learned the syndication business from some venture capital and merchant banker type clients. I learned what a Reg D was and the various rules and how to account and report to all this. So I've been doing that stuff for 30 years. And so I really kind of come to the real estate syndication business a lot different than a lot of other people. I'm a member of some masterminds that's about capital raising. They're all doing real estate deals, but they don't come at it from a financial standpoint. None of them are CPAs, and none of them are, they're sales oriented, or they're marketing oriented, and so they've really got a leg up on me in some of the capital raising world. So I had several fractional CFO clients going into the COVID pandemic. We exploded that client list during the pandemic as everybody and their brother wanted to get a PPP loan, and why not? The government was giving away free loans and then forgiving them, and so. But it was a difficult application, so they needed somebody with our talent. So we were able to do that, and we were already thinking about how to how do I get back into real estate, because I wasn't in any real estate at the time. And so I was making plans for building a fund or whatever. And then, we never did do the fund, and we can talk about that in a minute. But so I just began to pivot, and there seemed to be a natural transition point for almost all of my clients. My fractional CFO clients began to graduate to full-time people. So, I was helping them grow their businesses, and they needed full-time people rather than a part-time Stewart. And so I just began to try to replace clients with pieces of real estate. If that makes any sense. We'd acquire a piece of real estate and we'd take the property management income, that would replace, the income you need to do day to day while we're running it and paying investors their distributions and whatnot. So that's how we began to transition. I wouldn't say we had a master plan. We still have some fractional CFO clients. It's not our focus anymore, but people that I've known for a long time. We do take on the occasional advisory client if somebody's looking at say a real estate problem, or we're happy to meet with them and advise them. The real estate world's rather big. There's plenty of real estate for everyone, and so a lot of us don't really see each other as competitors. So we're happy to help each other out, even if we're in the same market. So,
okay, that makes sense. I went a little bit too fast. I thought you were a fund from the beginning, but there was the fractional CFO advisory, a capital raising, obviously, in order to get into the fund business. Are you right now a REIT, Real Estate
we are
Investment
not.
Trust?
We are
Oh,
not.
okay.
Harvard Grace Capital is the sponsor and originator of 9 separate syndicated real estate deals, so we've done those in our last 3.5 years. We did our first deal in January of 22. And so, but each deal stands alone, and each deal has separate investors, different number of investors. We have a lot of the same investors across our many deals, and other deals we just have one or two. But we found the deal, we originated it, we negotiated the contract, we arranged the debt, and then we operate the property. But we are not a REIT.
Okay.
Yeah,
Okay.
nor are we a fund. So
yeah. Yep. Okay. Yeah. Then it's different deals. Then how do you structure your deals and partnership with your passive investors?
Yeah. So, I told you about how I had clients early on in my career that were doing syndication deals, and really syndication hasn't changed a lot, probably in the last 50 years. There's even though they used to be formed as limited partnerships, and there'd be a general partner and the investors were limited partners. We don't use partnership structures anymore. We use LLCs. Still, you got the role of what's called the GP, which stands for general partner, but there's no partner. So you got a manager. So you got the manager, and then you've got the investor class. So depending upon the economics of the deal, we will raise the equity, and the investor class will have anywhere from 70 to 50% of the equity, and then they have control of all of the cash flow from the deal, from the get-go. So just for easy math, we raise $1 million to do a property, and just say that property pays out $250,000 a year of net operating income. Well, every single dime of that will flow to the investor class, Class A, as we usually label it, until two things happen. One, they've received 100% of their investment amount back. And two, then they receive a preferred return on top of that. Usually it's 8.5%. That can go up and down with market. Ours has always been 8.5% in the last few years. So before we, the operator, the GP, if you would, the manager, get a dime out of the cash flow, the investor class gets all of their money back plus their preferred return. At that moment in time, then we walk forward together with them getting 70% of the deal, and then we get 30% until such time as the property is sold. And that the same thing will happen if you refinance the property and you pull cash out. The same waterfall applies. So it's a
Okay.
little bit different because we also invest directly into the deal alongside their Class A other investors. So we're on both sides of the equation because people like to see the sponsor of the deal with cash in the game, and I mean, and we believe in our deals, so we're happy to put good hard cash in there too. So.
Awesome. Yeah, I love it. That's very smart. And what kind of clients are you seeing most momentum with right now? If you're getting new clients, or it's only the one
Um, are you talking about advisory clients or investors?
investors?
Yeah. So right now we target high net worth individuals, accredited investors. So technically, we do only 506C, Rule 506C, as an exemption under Regulation D. And using that rule, it requires it requires us to only accept investment from accredited investors, and that allows us to do general solicitation. I can run TV ads, radio ads, email blasts, or whatever, which you can't do under some of the others under Regulation D. So accredited high net worth individuals, these are who you think that would be successful business people. And I like to say these are the people that I pursued as my clients when I had a CPA practice, and I have a rapport with them. I have, I have to stop myself sometimes because being a CPA forever, sometimes I'll just start advising them. Well, you might think about this, and that's not what they've hired me to do. But these are the people, small business owners. Of course, that includes doctors and dentists. And then there's the occasional. We do have a few family offices that we work with, and that's always a unique opportunity and a challenge. They are they're not like everybody else. They're managing money as a way of life and managing their own money. But we're pleased to have 3 family offices as a part of our investor network these days. So
That's very, very interesting. That's great. Then your as I saw, your portfolio is spread across uh, medical offices, medical office spaces, retail centers, suburban offices,
yes,
even self storage,
yes.
and in places like Birmingham, Madison, Huntsville. What do those properties have in common, and what's your thesis behind those choices?
Um, the main thing those properties have in common is me. so so we are investing in what I call my backyard, and it's a big backyard. So we have an investment corridor that's essentially I-65, Interstate 65, that runs from Mobile, Alabama, up to Chicago, Illinois, and I have lived my life up and down I-65 from Nashville on down through Birmingham, and so these are areas that I know very well. And because we also do the property management, that does somewhat limit the geography in which we can invest. So we have to be able to get to any property, within an hour, at the most. So what they really have in common is that it's an area I know well. I live in southern Middle Tennessee. We're in the Huntsville, Alabama MSA. I was born and lived in Birmingham for a while. I've spent a lot of time in Birmingham. Our first property, which I'm in right now, where our headquarters is in Spring Hill, Tennessee, just south of Nashville, where I lived most of my adult life, just north of here in Franklin. So, what do these things have in common? Me.
Yeah.
These are areas that I know, and I've watched them grow up, and we're and we know what's happening in these areas and become very we're very confident in the continued viability of these properties. Um, and I think you're also alluding, what's our thesis? Our thesis is we want to invest in properties that cash flow from day one, and which are pretty rare to find. And I would say also we're somewhat unique in the passive investing space, in that most deals out there are either new construction, they are value add deals. We're going to buy this apartment building that's 25 years old. We're going to rehab them all. We're going to raise the rents 3x, and then we're going to sell it. It's a great business model. There's no cash flow in that 3 years, though. So we are just we're trying to provide a product for investors that provides recurring cash flow, because we feel like that's the foundation of should be the foundation of everybody's investment portfolio. And we don't see a lot of products out there. You can buy an annuity, or you can buy some dividend yielding stocks, which has traditionally been a great value, but then you see your principal go up and down like crazy, and it's just, you just don't see that. Cash flowing real estate is, to me, an ancient and a very traditional wealth building tool used by really the richest people in the world. And why shouldn't everybody think like? I think there's far too much focus on big capital gains and IPOs and things like that. So that's a product we're bringing to the market, which is cash flow. Our cash flows will increase over time, and our properties are boring. We're not doing development. We don't do floating rate debt, and we eliminate every risk possible other than Mother Nature and vacancy risk. And no matter how hard you try, you can't make the tenants stay and pay. And sometimes they're going to move. But that makes our properties, like I say, very unexciting, very boring, except that at the end of the day, you get a regular payment, which is not very boring. It's just income, and so that's what we bring to the market, and that is our investment thesis. And so these properties that we found, they fit that bill. So
that makes sense. Perfect explanation. Then obviously cash flow. Okay,
yes,
but what type of return or impact are you aiming for?
yeah. So for the investor, and we usually we'll calculate this in years of 5, 5, 10, 15. But going in, we are expecting an IRR, which is a combination of a capital gain and the cash on cash return that you receive, into the low 20s. So call it 22, 23, even 24, 25. That's what we're estimating. And it assumes a sale at the end of year 5. And you have to assume a sale at some point, to do the calculation. At this point, our cash on cash across our portfolio is in excess of 10%. Most properties will start out about 5.5 or 6%, and then they kind of grow rapidly and get to double digits within a few years. We've not had an exit or sold a property yet. What we do in the interim is we will refinance a property if the economic conditions are right and the interest rates are right. As we have improved the value, we pull that cash out, which is a tax-free transaction. We give that back to the investors, and that adds to their IRR as well. So usually we expect to do at least one refi in a 5-year hold period, and then and what we try to do is, with that refi, we get the investors 100% of their cash back, and so now they're still an owner. They're still getting cash flow, and they've got their cash back. And hopefully they're saying, "Hey, Stuart, what else you got? Let's go do another deal." But whether they do that or not, there's no requirement, of course. They've got cash back that they can go expand their portfolio and to do something else. And again, that was tax free, which also enhances the IRR. But to answer your question, we really expect our investors to be receiving a low 20s IRR, which is pretty strong for a stabilized property, frankly, which is what we do. So.
Yeah, no, very good return. Um, I may add. Then basically any project that really surprised you, or either a home run or a learning moment.
Well, I can give you one of each if that's okay. So, we'll start with the
Please.
learning moment, which is let's just say it's not a home run yet. So, we bought a medical office building in Huntsville, great part of town, right sort of in the middle of this medical neighborhood near a hospital, just doctors everywhere. A doctor was retiring, selling his practice in his building, and we bought the building. And I thought, well, we won't have any problem re-renting his suite. I mean, it was built out very nicely, shows very well. So we bought that 2 years ago. We just leased that suite this week. We've been very close several times, and finally just inked the deal on Monday. And I'm like, well, that was not the business plan. I did forecast that it would take us 12 months, thinking it'll take us 6, but it took us 24 months. And sometimes that's the risk. We had plenty of cash. I raised plenty of cash in reserves, so I haven't had to ask any of the investors for any money, and we still have tons of cash. I'll actually, now that that's leased and we don't have a big build out to do, I'll be sending them back some excess reserves here next month. But that's just one of those didn't go according to plan.
Yeah.
And I say I eliminate all risks except vacancy risk. Well, that was the one that that bit me in the rear end. And I'm just, we don't know why. We must have shown that property 30 times over 2 years and never could get any concrete reasons why nobody wanted it. Anyway, deal's done. We're moving forward, and we will refinance that property before the end of the summer and pull some of that cash back out.
Wow, good.
You make your money on the buy, not the sell. And we bought this property really, really well. And so we have a very low basis in it, and probably 50% of what the building's actually worth. And with the building full with cash flowing tenants, it's going to appraise very nicely. And so the refi will be another victory lap. So that's my hard knocks lesson learned. On the upside, my storage facility in Huntsville, which is a niche, so it's 125 units, all for boats and RVs, so they're all big.
Oh.
And we bought it from the guy who built it, who's actually still a tenant there. And I says, well, great. This is going to cash flow very nice. And people, we did this right after COVID, where everybody was buying boats and RVs, and great. Well, what we learned very quickly was that there was far more interest from small business users who wanted big 1,000 square foot spaces, and there are smaller warehouses that can start at 2,500 or 3,000 feet, and they were costing like 3x per square foot what we were charging, and we liked our rate. But businesses started coming in, and they'd start with one, and then then they want another one. We now got people in there that have 4 or 5 units, and so our business demand just far exceeded the recreational RV owner who just wanted a nice, safe place to park his toy, and And frankly, the business users are willing to pay far more than the RV user. And so we've been able to raise prices there every quarter for the past 2.5 years, to where we have now doubled the revenue on that, which has also led to doubling the expected cash flow distribution, back to the owners, and to the point where we're also expanding that facility. We're about to add another 75 units, and hopefully just keep it going. So that was a surprise to the upside, So
Wonderful.
we keep raising the rents and nobody leaves. It's an amazing. I haven't found the price at which people leave yet. So
Yeah, don't push it.
well, we're going very gently. So
Yeah.
I'm not going to push that too hard until we lease up the ones we're about to build. So
Great story, and bravo. Um, on the other hand, every business hits inflation point
yes.
um, sometime, and I know real estate, especially today, isn't without its headwinds. Um, what have been some of the key challenges you've had to navigate?
The biggest challenge we face is really when we're taking over a new property. And I said earlier, we don't do value adds, which means physical construction or anything like that. We feel like our value add that we bring to a property is professional management. And you kind of hit on the big word. I'm an old guy. I remember inflation. I came out of college when we had double-digit inflation and double-digit interest rates. That was called the misery index, and we dealt with inflation right up until mostly about the year 2000 or halfway. It was under control at different times, but it was an everyday topic. Right now, if you're under 40, you've probably never heard the I word, and it's not your fault, but you've never really heard it. It's never been a factor until 2022. And me and my old guys and my friends, we get together and it's like, they start pumping $6 trillion into the economy during COVID, to get to, and we're like, all right, again, us old guys look at, well, when does the inflation start? And because it was the most predictable period of inflation, in modern history, just because that's what happens when you pump a bunch of free money into an economy. And real estate is probably the only asset class which is, if properly managed, which is ready set to adjust to inflation. Either you've got short-term leases that you can raise the rates on, or if you've properly done your long-term leases, like in our medical office buildings or our other office properties, and you build in escalators and cost pass-throughs back to the tenants. If you've properly structured your lease, inflation is not a headwind to you. It's just a thing. And so you're passing those costs onto your tenants as much as possible. So the biggest challenge is when we've taken over a new property and you have to live with the leases in place, that were there when you bought the building, until you get the opportunity to renew them and renegotiate them. So you got to live with the bad leases that were negotiated before. We've taken over some properties where they hadn't raised rents in 15 years. And we know that going in, that's the problem and the opportunity. We buy the property on that basis from the inferior market cash flows, and we're going to buy it for what the cash flow is, knowing that in 3 to 4 years, we can reposition that property, having been able to renegotiate the leases on 80 or 100% of the building at market rates. And suddenly your building's worth 2x or 2.5x of what you bought it for. And so that's the headwind. It's really living with what you bought, and if you don't have a cost path through, yeah, we're living with the cost increases and stuff like that too. So
Okay. Yeah, that makes a lot of sense. And okay, then you know how to survive or handle inflation. And how do you handle market volatility, interest rate shifts, or investor skepticism?
um, we certainly have had our fair share of investor worry. You know, when interest rates go up and down, you know, we get calls. You know, hey, are we okay? I mean, they forgot my rule because you know they're investing passively. I don't do floating rate debt, and I do that on purpose because again, a lot of the ways I operate is because I've made this mistake before. You know, I've been burnt by floating rate debt, as a lot of guys did recently. I mean, who would have ever thought that the Fed would have raised rates 5.5 points inside a year? I mean, it's unheard of. And I can't really blame any operator who's doing a development deal who didn't anticipate that. I mean, who would? But once we're in a property, we're really not affected by interest rate fluctuations. If interest rates go down, you know, then there may or may not be an opportunity to refinance. If interest rates go up, well, we got a fixed rate. You know, investors get concerned, and we deal with investor worries. We've just come through a time where a lot of investors have just been sitting on the sidelines. Just due to economic uncertainty, you know, they hear the R word, the recession word. They hear stagflation. They hear all kinds of stuff, and a lot of it's nonsense. And who's to say what is the nonsense and what is just noise? You know, so and I think a lot of their cases, the proper thing to do is sit and wait. And we've been sort of doing the same thing because you know we don't have to do a deal you know, to keep the lights on. I don't have to have that deal fee or anything like that. So you know, our properties are operating, our holdings are stable. So, you know, interest rate fluctuations, you know, they're really opportunistic. They are. Uh, I've just seen really for the first time in years different interest rate environments in different parts of the country. I used to say that all real estate is local, but all finance is global. You know, that you would get the same interest rate in California as you would in Nashville, Tennessee. But, you know, I've just pursued a property in Florida, and the banks down there were still around 7.75 to 8 when I just financed two properties in Huntsville earlier this year at 6.5. And I'm like, wow, you know, that's really different. So we are starting to see some different markets in the finance, and a lot of that's banks. Some banks are hungrier than others and whatnot, but you know, it seems as though most of the financing in Florida is sort of holding. You know, they're holding back and trying to slow things down a bit. So, not sure if I answered all your questions.
Yeah, no, of course you did. I mean, it's a lot. I mean, okay, let's move on to tech.
Sure.
AI is changing the way we evaluate deals, manage assets, and and forecast risk. Um, have you started integrating tech or automation in your process at Harvard Grace?
We have uh, yeah I've yeah I got out of college the year the IBM PC hit the market. So I've been following tech really my whole career, and I like tech, and I can geek out with it. And so we like to be on the cutting edge, and I'll say the first pieces that we do are prop tech, you know, smart devices and monitoring devices that we can put for either access control or monitoring and managing HVAC, that you know we can control from our remote location and things. And some of that's been around for years, but the AI is definitely making it smarter, and that stuff is fun. Tenants like it as well a lot of times. Um, I've been implementing it so far this year. We have a robust publishing program. We do a lot of social posts. We do about 10 emails a month on various topics. And so I have it helping me write those, and I also have it helping me find people that we might want to add to our email list. So we're using it on the capital raising side as well. I'm not near as smart in AI as I need to be. And it's one of those fields that's changing all the time. So you might can help me with that. Um, on the investment side, I'm not sure. It might can help me start a conversation, but I really think the investing will continue to be a relationship business, and so AI will be a tool that we can either use smartly or stupidly, and hopefully we learn how to use it smart to work smarter, work better, and faster.
Yeah, I mean, yeah, we even though I mean everybody talk about it and it's here to stay, but I mean it's already there for many years basically. Um, but you could use also AI for financial modeling, I guess.
Yeah,
This you know
I
that.
haven't
Uh,
endeavored in that yet, but
okay.
yes, I would like to
Or
do that.
maybe also due diligence
Hmm.
on finding scouting properties um, or investor communication. This is
Hmm.
the what you talk about.
Yep.
Um, then yeah, all this is could be enhance your productivity. Do you have any? Do you see any? Do you see AI playing a bigger role in real estate investing in the near future?
I do, and I think it's a lot of the things that you just mentioned. I can't wait for it to help me with due diligence once we've identified a property, because you can, usually I've just got to block out 2 days of internet research and going to, and sometimes you're looking at a building where the local government hasn't even computerized their records yet, much less made them available on the internet. So sometimes you got to go there. So to the extent that um, you can give the AI search parameters, and where it can generate those reports in a matter of minutes or even hours would be fast enough, frankly. And and so that's a major time consuming thing that I think that the AI is just perfect to be able to solve that problem. uh, we will be using it more and more in our communications, and things like that. Um, so yeah, it is a major goal of ours this year for me, for this old guy to get better and better at it. So
No, no, for sure. Okay, let's zooming out a bit. Where do you think CRE, commercial real estate, and capital raising are heading over the next 3 to 5 years?
um, maybe this is just an entrepreneur in me. So I feel like we're coming to the
Please.
end of a of about a 12-month period that's been a cooling off time for a lot of passive investors. And I think the cooling off period has been brought on by really the raise in financial in interest rates and in financing problems. So a lot of passive investors, our investors don't just invest with us; they invest with lots of other people. And most of the deals out there, as I said before, are these value add or a new development deal. And almost every single one of those deals is financed with a floating rate mortgage. And so a lot of those guys have had to, re-engineer the deal. Um, they've had to make capital calls. Other deals that financed their acquisition with floating rate debt that were operating deals, their interest costs went up, and so they've had to suspend distributions and blah 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 blah. So we've seen fewer and fewer investors really interested or much less excited about passive real estate deals. I think we're coming to the end of that. It's been a cold zone, and I'm just fortunate. We've closed 4 deals in the last 12 months, and and I think that's because of the way we structure our deals and the way we eliminate risk. And again, I'm not pointing any fingers at any of these other guys. I mean, those are a lot of those are fabulous deals, and a lot of those guys are great operators. It's just the floating rate debt is the reason that they had their problems. So I say all that to say, I really believe in the second half of this year, real estate is going to be a target-rich environment. One of my friends calls it a back up the truck moment and load it up. I'm gonna call it a generational opportunity for buying first class assets at really, really great prices. What we've seen in the last 5 years is a slowdown in most development, and what that really means is for anybody who owns the assets, because nobody's building new stuff, what you've got is worth more. So, development will never catch up. We're at a nationwide basis. We're at a 15-year low on supply for housing, and you can break that down further by region and by asset type. But that does include single family homes and multifamily units. Nobody has enough housing. Period. And there is demand out there, but because of financing, developers can't afford to build it in a way that and deliver it to a market that can afford to pay for it. So, we've always been somewhat behind on housing, and you should expect so because housing is always looking forward. But to me, that's a real opportunity. And where housing goes, commercial development will follow. But just going back to what our focus is, there will be more and more of these stabilized assets. People will be wanting to exit. People have not been able to exit because nobody could afford to borrow or buy, and even us who are still in an acquisition mode, we're not going to buy at the price you want because of the interest rates today. It has to meet our mathematical or financial parameters. Anyway, we've been hearing about the debt wall coming really since the fall of 2021. And I think a lot of banks have been extending and pretending, and I think the debt wall is going to finally crumble. There's going to be a lot of property hit the market, good property with no intrinsic problems other than how it was financed. And so those are going to hit the market, and guys like us are going to buy them, and we're going to make a lot of money doing it. So
you have to raise capital.
Okay. Got to raise capital, and there will be investors. There's a lot of cash on the sidelines waiting for the opportune moment. So,
yeah, I mean they're on the sideline because of uncertainty, Trump policy, and and else. Regarding housing or residential housing, we always lagging and we're always missing, and that will always be like this. We're always going to be missing properties, and not only in the US, in Europe, the same thing. Here in Spain, it's a disaster. Then we don't know. I mean, the developers are making a lot of money. They're building and building, but it's never enough. But yes, maybe you're right. Hopefully, the opportunity is now, and I wish you the best. That's great. You've been building businesses and advising others for decades. What guiding principle have stayed consistent for you throughout your career?
Um, well, I'm a person of faith, and my faith tells me to treat people right, operate with integrity, and above all, be honest. And um, I've been told I'm the least greedy person in real estate they've ever known. It's like, oh, okay. I like to make money. I don't get me wrong. I like business and I like competing and I like winning. But at the end of the day, I do put my investors and clients' interests first, and I'm happy to be second in just trusting that if I'm doing that, I'll be taken care of too. So I guess you could call it the golden rule. Treat other people the way you want to be treated. So.
I love it. Very humble. And what do you hope people say about Harvard Grace Capital 10 years from now?
It's a good question. I hope that they'll say you can trust what Stuart says. If there's a problem, he'll be honest with you about it. And at the end of the day, they will come through and make everything right. So every deal's not going to go perfectly. So, but just trust that we'll make it right. So.
Yeah. What keeps you motivated on the rough days?
Not to be cliche, but I've got a bunch of kids, and once you have kids, you stop thinking about yourself mostly, and I would like to leave a big legacy and some assets, some cash flowing assets behind, so that they can not sit back and be lazy by any means, but they can have some assets to grow with or to build a foundation on and enjoy life with. So
Beautiful. I love it. Stewart, this has been a really, really insightful conversation. I really appreciate the transparency and the wisdom you have shared. And where can folks go and learn about Harvard Grace Capital and follow your work?
Well, thank you. It's been an honor being here. Really appreciate the opportunity. The best place to connect with me, and I do invite people to reach out and let's have a conversation, but is find me at Harvard Grace Capital. Just like it sounds, you can find my contact information, my email. You can even find my Calendly link there if you want to book some time with me. You can also explore the site, look for some of our resources that we have that are free, and if you want to join our mailing list, you can do that there as well. But I do sincerely offer anybody you want to talk, reach out. We'll talk. So.
Look, the proof is in the pudding. I really, really, really love this conversation. Thank you so much, Stewart, for joining. And that's it for today's episode of the AI InterConnect podcast. If you enjoyed it, share it with someone who is building the future, or better yet, someone who should be. And until next time, stay curious, stay creative, and keep building. Thank you, Stuart.